It's 3 a.m. and you're staring at your phone watching your investment account drop another 5%. Your coworker sold everything yesterday. Your brother-in-law says the whole system is collapsing. Every financial headline is screaming panic, and your finger is hovering over the sell button. Here's what I'm going to show you. That exact moment when you feel the most scared is probably the best buying opportunity you'll see in a decade. And the math behind why that's true might completely change how you think about market crashes. My name is Ivan, and I spend way too much time thinking about money, human psychology, and why some people seem to build massive wealth during the exact same market crashes that destroy everyone else's portfolios. If you've ever wondered why the richest investors seem to get richer when markets tank, make sure to hit that subscribe button and give this video a thumbs up if it helps you understand what's really happening during a crash. Think about it like a fitness test. You don't actually know how strong you are until something heavy shows up. Market crashes are the stress tests that separate people who understand investing from people who are just along for the ride. And here's the uncomfortable part. Most people fail the test every single time. The discount window opens when everyone runs away. When markets crash 30 to 50%, most people think wealth just evaporated. But here's what actually happened. The companies are still there. The buildings didn't disappear. Employees still show up. Products still sell. The only thing that changed is the price. Imagine you own a rental property generating $1,500 a month. You paid $200,000 for it. The real estate market crashes. Similar properties now sell for $140,000. Your property lost 30% on paper. But did your rental income change? Nope. Did your tenant leave? Nope. The only thing that changed is what a panicked buyer would pay today. This is exactly what happens in stock market crashes. The underlying businesses keep functioning, but the price drops because humans are emotional. Fear creates selling. Selling drops prices. Dropping prices create more fear. It's a cycle that feeds on itself. And that cycle creates an absolutely bizarre situation. The exact same company generating the exact same profits suddenly costs 40% less just because people are panicking. Your favorite store putting everything on sale because customers are scared to come in. Most people see that sale and run away. A small group backs up the truck. Same situation. Completely opposite reactions. Completely different long-term results. Here's where your brain chemistry works against you. When your portfolio drops, your stress hormones spike. Cortisol floods your system. Your fight or flight response kicks in. Evolution wired you to run from danger, and watching your account balance drop feels like danger. But here's the catch. That fear response that kept your ancestors alive is the exact thing that destroys investment returns. The worse you feel about the market, the better the buying opportunity probably is. Your emotional pain is inversely correlated with investment opportunity. During the 2008 financial crisis, the S&P 500 dropped from about 1,500 points to 700 points. That's a 53% drop. If you invested $10,000 at the bottom in March 2009, that investment would be worth about $60,000 today. That's a 6 times return in 15 years. But here's what makes this powerful. In a normal market, the S&P 500 returns about 10% per year on average. To turn 10,000 into 60,000 at 10% per year would take about 19 years. By buying during the crash, you compressed 19 years of returns into 15 years. You accelerated your wealth building by decades just by buying when things were on sale. Let me show you the compounding accelerator that nobody talks about. This is where the real magic happens. Say you're investing $1,000 a month into an index fund. Normal market conditions, the fund costs $100 per share. Your $1,000 buys 10 shares. Market crashes 50%. Same fund now costs $50 per share. Your $1,000 now buys 20 shares. You're getting twice as many shares for the same money. That's obvious. Here's what people miss. Those extra 10 shares you got during the crash compound for decades, they grow with every market recovery. They pay dividends that get reinvested. 20 years from now, those extra shares you accumulated during the crash might represent 30 to 40% of your total portfolio value. You didn't invest more money, you just invested the same money at better prices. And that difference compounds into massive wealth over time. Two people both investing $1,000 a month for 30 years. Same discipline, same consistency. Person 1 invests straight through, including during crashes. Person 2 gets scared during crashes and stops investing until things feel safe again. Over 30 years, with a couple major crashes, person 1 might end up with 50 to 70% more wealth. Same monthly investment. The only difference is person 1 kept buying during the crashes. Now, the part that makes people uncomfortable. During a market crash, wealth doesn't disappear. It transfers from impatient people to patient people, from emotional people to disciplined people, from sellers to buyers. When markets crash, scared investors sell their shares. They're willing to accept much lower prices just to get out, to feel safe, to stop the pain of watching their portfolio drop. Who are they selling to? Somebody has to buy those shares, and that somebody is the calm investor who recognizes the opportunity. Every transaction has two sides, a seller and a buyer. During a crash, the seller is accepting a massive loss. The buyer is getting a massive discount. Fast forward 5 or 10 years. The market has recovered and hit new highs. The person who sold during the crash locked in their losses. They never get that money back. The person who bought during the crash sees their investment double or triple. The money didn't vanish. It just changed hands. It transferred from the person who panicked to the person who stayed rational. Let me show you what this looks like with real people. Rich Richard started investing in 2006. He was 28 years old. Good job. Started putting $500 a month into a retirement account. Then 2008 happened. Richard watched his $15,000 drop to $7,000. Every single day he'd see red numbers. The news was terrifying. His parents told him to pull his money out, but Richard did something different. Before he started investing, he read about market history, he knew crashes happened, he knew they were temporary, he knew the market always recovered eventually. So Richard made a decision. He didn't sell. In fact, he increased his investment to $750 a month. He figured if stocks were on sale, he should buy more, not less. Was he scared? Absolutely. Did he doubt himself every single day? Completely. But he trusted the data more than his emotions. From March 2009 to the end of 2010, Richard invested while the market was still low. He accumulated shares at prices he'd never see again. Fast forward to today. Richard's portfolio is worth about $450,000. Now meet poor Peter. Peter also started investing in 2006, same age as Richard, same $500 a month. Peter also watched the 2008 crash happen. He saw his portfolio drop. He felt the same fear Richard felt. He heard the same scary news. But in March 2009, Peter couldn't take it anymore. He had about $7,000 left. He sold everything, moved it to cash. He told himself he'd get back in when things stabilized. By the time things felt safe again, the market had already recovered 30%. Peter waited even longer. Eventually, he got back in around 2012. By then, the market had more than doubled from the bottom. Today, Peter's still investing. He's doing fine, but his portfolio is worth about $250,000. Same starting point, same monthly contribution for most of the time. $200,000 difference because Richard invested through the crash and Peter sold. Peter tells people he got unlucky with his timing. Richard doesn't talk about it much, but the numbers tell a very different story. Here's the reframe that changes everything. Most people think investing is risky because markets crash, but that's backwards. Markets crashing is how investing creates wealth. It's the feature, not the bug. The crashes are what create the discounts. The discounts are what create the outsized returns. The outsized returns are what create wealth. Without crashes, everyone would get average returns. The opportunity exists because most people can't handle the temporary pain. The market going down isn't the risk. You panicking and selling is the risk. If you invest in solid companies or broad index funds and hold for decades, temporary crashes are just noise. Annoying, scary, uncomfortable noise. But if you sell during a crash, you transform that noise into permanent loss. You take temporary volatility and make it permanent damage. Richard understood his emotions were the risk, so he stayed invested. Peter thought the crash was the risk, so he sold. Same information, completely different frameworks, completely different results. Cowrie. Let's talk about the survivor's advantage. The companies that survive a crash often come out stronger. The weak companies die. The strong companies survive, and the strongest companies actually gain market share. During the 2008 crash, thousands of banks failed, but the big banks that survived got bigger. They bought up their failed competitors. They consolidated the industry. They came out stronger than before. Every crash is a stress test. It reveals which companies are actually strong and which were just coasting on good market conditions. When you invest in a broad index fund during a crash, you're buying the whole market, which includes all these survivors, all these companies that are going to emerge stronger. And after a crash, there's usually a period of explosive growth. The weak are gone, the strong are hungry. The economy starts recovering, and the surviving companies grow faster than they did before the crash. Look at what happened after 2008. The bull market that followed lasted over a decade. It was one of the longest and strongest in history. Or look at 2020. The COVID crash was followed by an incredibly strong recovery. This pattern repeats every cycle. Crash, survival, recovery, explosive growth. And the people who invested during the crash get to ride the entire wave. Here's what you actually need to do. 2 strategies. First, automate it. Set up automatic investments that happen regardless of how you feel. Your emotions can't sabotage you if the decision is already made. Transfer $500 or $1,000 or whatever amount you can consistently do into your investment account every single month. Use a broad index fund, something like VTI or VOO, not individual stocks, not crypto, not whatever your coworker is hyping, boring index funds that own hundreds of companies. Second, reframe the pain. When you see your portfolio drop, don't think I'm losing money. Think everything just went on sale and my next investment will buy more shares. It's the same event, but the framing completely changes your emotional response and your behavior. Make this decision now while you're thinking clearly, because when the next crash comes, and it's coming, you won't be rational. Nobody is. The people who succeed aren't more rational. They're just better prepared. Quick sanity check on the objections I know you're thinking. But what if it keeps dropping? Then you keep buying at even better prices. Over a long enough timeline, the market has always recovered. Always. Every single crash in history has eventually been followed by new all-time highs. The Great Depression recovered. 1987 recovered. The dot-com bubble recovered. 2008 recovered. 2020 recovered in record time. If you're investing money you won't need for 5 to 10 years, the question isn't if the market will recover, it's when. And that when doesn't matter if you're patient. But what about inflation eating my returns? The stock market has historically outpaced inflation by about 7% per year. Even accounting for inflation, buying during crashes accelerates your real wealth building. But I can't afford to invest more during a crash. Then don't invest more. Just don't stop investing what you're already doing. The people who win aren't necessarily investing huge amounts. They're just not panicking and selling or stopping their regular contributions when things get scary. Here's the contrast that matters. Average person saves 6% of income, stops investing during crashes, sells when things feel scary, buys back in when things feel safe. Result is decades of spinning wheels and missing the biggest wealth building opportunities. Disciplined person saves 12 to 20% of income, keeps automatic investments running no matter what, never checks account during crashes, holds boring index funds for decades. Result is compound growth that accelerates during every market downturn and builds serious wealth over time. The difference isn't intelligence, it's not luck, it's not even income. It's understanding that temporary discomfort creates permanent opportunity. It's becoming the kind of person who can watch their account drop and think that's interesting instead of, oh no, the next crash is coming. We don't know when. We don't know what will cause it, but it's coming. That's how markets work. When it happens, you'll have a choice. Join the majority and panic, or join the minority and invest. One group will look back with regret. The other will look back at it as the best financial decision they ever made. Set up your automatic investment today. Write down your plan now. Commit to your strategy before your emotions get involved, because in the moment of a crash, you will not be rational. But if you automate the decision, now you don't have to be.